This was an embarrassment beyond belief, but it also set off a war between the UAE and the LBMA, one that has taken 3 years to play out.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. Live from the Vault is a show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. We bring you exclusive access to the experts and the insiders, and we reveal information and insights that you simply won't find anywhere else. Hi there, my name is Shane Moran, and I'll be your host for this week's episode, and we'll be joined shortly by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of the gold and silver markets, and we expose what's really going on in the precious metals industry. So get ready for another packed episode of Live from the Vault, and we bring you the knowledge, we bring you the understanding that the mainstream media just will not provide. So just before we head over to the UK, please help us spread the word about this program, about this channel by hitting that like button. You can do it right now. Share this information so more people can find out about what's happening in the precious metals industry, and share the information. Subscribe if you haven't already done so. Do that right now. And if you click on that bell right there, we'll notify you as each episode goes live. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, through the fog of all the noise out there, many people have been calling for big pullbacks in gold, but you never once wavered from the assertion that gold was going to rise into the end of the third quarter. And that's only a few days away from now. Can we look at, as we get started here, let's look at what you're expecting moving into the fourth quarter.
Yeah, great to be with everyone again. And thanks, Shane, for accumulating these questions. So really, one by one, all of the historical drivers which basically had enabled the synthetic gold price suppression game for the entire tenure of the last 50 years, obviously COMEX market-centric history, have systematically run into the identified central bank physical buy levels that we've identified along the way up from and this was really kind of where we drew major attention to it, was after the Fed's massive miscalculation in mid-February. We looked at it in the charts. We'll look at it a bit again in a little while, but which is when they tried to chart paint gold through $2,000 into very strong Asian physical buying. And that blew back. Commencing, really, that was where we saw the commencement of a over $600 per ounce rally into central bank driven physical shortages, forcing the Fed to begin folding its spoof hand. Now, every other central bank, and first tier bullion bank for that matter, is long gold for their own books and are continuing to buy gold into every single dip. Now, we've evidenced the Fed agent banks, largely populated by the swap dealers, as we call them, the commercials, we've evidenced them short covering at the top of the current range. Now, obviously, short-term volatility aside, this is a huge change in behavior, and it is a clear sign that the Fed is beginning to capitulate. And it leads us into what to expect as we head into the fourth quarter, and why. After we pop into look at the charts a bit later, I'll provide the rationale for the expectations of a Russian-driven $3,500 gold price forecast.
Now, Andrew, you went on record at the start of this quarter, the third quarter. I think gold was trading around $2,300 level, and that you said there was sufficient physical demand to force a further $300 rally into the 2600s. Once fresh physical stair-step was established, there would be sufficient short stops above the market to force a fourth quarter price of around $3,000 to emerge from the COMEX swamp, as you put it. Is this still your expectation?
Absolutely, it is, and I think it's really important because obviously what we're doing is bringing in the physical market side to the market. Everyone can chase the synthetic market, but there is a physical limitation to what they can do, especially as the exchanges start to settle physical markets outside of the LBMA. Now, the reason we're able to withstand all of the official wash and rinse cycles attempts, which have been we've been tracking them, how they've sucked in the speculators, gaslighted them into thinking gold was a good short, at each of the stair step supports, especially every time we hit a round number, whether it's 2200, 2300, 2400, even the half numbers like 2550 and so on. And the reason is because we're able to actually weigh up the synthetic market footprints against where we see these paper bets clash into enough central bank physical support levels that force these 96% leveraged synthetic bets to actually get unwound. And this kind of frees us up to focus on the larger picture. And it is these underpinning physical market drivers that really pushed back against the Fed's ongoing synthetic efforts to cap the price of gold against really a rapidly debasing dollar. And it's quite simple, really. It just requires a view into where the wholesale physical market's appetite is. And as these physical markets are increasingly being settled outside the Fed's reach, the scope of these synthetic-driven sell-offs are governed by how many of these 96% leverage bets can be cash settled against the speculators inside the COMEX bubble before it flows out of the casino into the real world. And this gold price suppression scheme has really been figured out by the competing central banks, swapping their debasing dollars for gold. Each unbacked paper market dip has dug a deeper hole for the Fed to actually clamber out of.
All right. Now, Andrew, as I remember, you drew attention to these competing central bank buyers stepping up their gold purchases after the 2008 Lehman crisis, but their footprints became impossible to hide around 2010. This is when the PBOC went on record swapping dollars for gold. Can you refresh us on how this continues to play out even today?
Yeah, you're right, Shane. We've been closely monitoring the distinct change in behavior that began in 2010 when China pushed back against the IMF's refusal to allow them to buy the remaining 200 tons of IMF gold that was put on sale at market. And if you remember, India had been allowed to buy 200 tons of the 400 tons. This was their last gold sale. And they put 400 tons on offer. India bought 200. And the remaining 200 tons was strategically parked inside the Bank of International Settlements site accounts. And that was, we did an episode about this. The idea was they didn't sell it to China, was they wanted to lend it out to the LBMA banks who are privileged to have gold accounts with the Bank of England. And this enabled the ongoing officially sanctioned 50-year-old price suppression mandate to continue all the way until, that is, the Bank of International Settlements went long gold on the 2nd of November 2022, exactly 1 month, or actually it was more like 6 weeks, before they revalued gold as a first-tier asset class on the 1st of January 2023. However, for the first time since Nixon slammed shut the window for central banks to exchange dollars for gold, this 2010 pivot marked the Sans Sou moment when China retaliated and began stealthily competing to swap dollars for gold so as to build its own gold reserves up against the West and at the expense of the West. And this was also the moment they opened up gold investments to citizens on the proviso that citizens' gold investments returns would be based purely on price appreciation, clearly sending a message they were going to underpin the physical gold price. Remember, they had built house-sized billboards put up, TV adverts, buy gold, buy gold. This was a strategic move. And despite every effort by the West to crush the gold price back down below this IMF sell point, outside the casino, the PBOC underpinned their citizens. They had their pricing was based in RMB, so they underpinned the RMB denominated gold investment price, meaning that at no time since 2010 have Chinese gold investors lost money on gold investments. Along the way, we've evidenced the PBOC opening up much wider access to the less wealthy citizens to invest in gold with the same guarantees. This is important. The same guarantees that investment returns would be based on price appreciation alone. And considering that Chinese traditionally save around 40% of their income, and gold is their best performing asset class bar none, in order to maintain the public's gold investment flow momentum, it meant that at times we've evidenced the SGE premiums plus or minus $150 per ounce when necessary above the debased CME LBMA cartel offerings. So no matter how much the Western-facing dollar price of gold was suppressed, the RMB price of gold was underpinned. What that did, of course, was incentivize China to bring in what was actually devalued gold, underpriced gold, to actually meet this huge demand, which richly backfired against the West. Now, worse for the Fed, the myopically focused Western-facing markets, synthetically derived, undeliverable. Let's face it, we were 96%. There only 4% skin in the game there. Undeliverable bets, paper price discounts. Western gold has been sucked out, alchemized in tonnage size, never to return. There is verifiable evidence that Chinese citizens now hold well over 25,000 tons. It could be more like 30,000, but conservatively, well over 25,000 tons of 4/9 gold. And when added to what has been accrued by the PBOC for a time of war, it provides Beijing some 60,000 tons of first-tier physical gold market liquidity. Now, this competing central bank gold demand evolved into a formalized gold alliance with Russia in 2013. I remember talking about this with Max Kaiser on one of his shows in 2013 as it was announced. Now, empirical evidence backs up our close contacts reports that Russia has also built very large off-the-record oil for gold accumulations, which, and I say off the record, which when aggregated alongside all the BRICs nations' gold investments, it likely adds another 20,000 tons of Sino-Russia BRICs nations' physical gold stockpiles.
Just to provide a little context so you know exactly where we're recording this. If you remember, this is where we recorded our last episode. It's always between the AM and the PM fix. This is Wednesday ahead of FOMC. And again, we're recording this right now between the AM and the PM fix. I just wanted to give you a bit of a view as to what's going on when we move over to the longer term charts. Now, obviously, we'll look at the short term action in a little while as well. But as we were really illustrating a minute ago, over and above all of this massive transfer of gold wealth from the west to the east, none of this could have happened had the BIS not got on the right side of the gold market by reclassifying gold as a first-tier asset class on the 1st of January 2023. And this is the exact point that occurred. Now, while still missed by the mainstream media today, it was no coincidence that the BIS divested themselves of all of the 50 years of accrued, up to 700 tons at times, but they had over 500 tons of high-risk derivative bets against gold. And they had that, they covered those literally on the 2nd of November 2022, just really a matter of a month or two before of reclassifying. Of course, it was no coincidence that they reclassified gold as a first-tier asset class. Now, this was the moment the BIS and all other central banks diverged from the Fed. The only central bank left trying to defend the price of gold, of course, is the Fed. And why are they doing that? To defend the rapidly debasing dollar. Now, every other central bank, sovereign, and bullion bank are long for their own book. This means that when we track short positions published on the CME website, we have to understand that because foreign exchange gold is a first-tier asset class, it has to be physically deliverable. But the asymmetric structure of these Fed bets against gold, and that's usually best represented in the swap dealer category of the COT reports, that has to be factored in. Now, the scope of this gaming is reliant on how many captive COMEX traders who are not licensed to access the FX markets directly, how many of them can be short covered into before these lopsided 96% leveraged bets, undeliverable gold that is, and these bets against gold flow out into the physical delivery markets outside the tentacles of the LBMA CME cartel. Now, these are the battle lines we witness now. And given the physical markets are now settled outside the West, the Fed continues to hold a losing hand.
So now we see the next major BRICs volley fired right across the LBMA CME Fed's bow. It has taken 3 years to blow back against the Fed. Their only remaining tool, that is. But blow back it has.
Yes, Andrew. Now, I recall you drawing attention to the start of this global gold battle way back in 2021. Can you remind us of what was happening then, please?
Yeah, Shane, we gave a lot more detail in our April and May 2021 commentaries. I know we did some work on this, which I actually would suggest new subscribers to go back and review, as this is where we drew attention to the LBMA's attempt to try and ring fence their shrinking share of the global physical trade. And what they were doing, they started by threatening to delist LBMA accreditations of all the other competing global refinery brands, unless they decided to capitulate into them. Now, we published a copy of one of the warning letters sent to the targeted UAE refineries. And this had, let's remember, it had nothing to do with 4.9's purity concerns. It was a brazen attempt by the cartel to maintain control of the paper market settlement process. Now, when the UAE pushed back, the CME and the LBMA cartel responded by delisting physical acceptance of a range of competing UAE bars. Alongside, they actually withdrew CME performance bond warrants from El Metal and Al Etihad, brand name gold bars. This was an embarrassment beyond belief, but it also set off a war between the UAE and the LBMA, one that has taken 3 years to play out. Now, we assessed right as this happened, the LBMA CME full court press attempted to ring fence their cozy little cartel arrangement to stem the erosion of their monopolistic hold over the global physical markets. It was ultimately bound to backfire, though, into what was really, when you think about it, a long-standing Sino-Russian, Indian, UAE refinery relationships. Long-standing, whereas the House is 100% reliant on operating within a fractionally held working stock environment where the physical deliveries represented little more than an electronically matched unallocated gold and silver squaring item on the books, settled really by netting out unallocated, highly leveraged gold credits and debits amongst the LBMA members' books. Whereas the UAE output represented undiluted outflows of 4.9's bullion, really impacting the global physical supply demand fundamentals, which is why the LBMA attempted to ring fence them. Furthermore, having control of all the LBMA, and this is a critical point, having control of the LBMA global production as financiers of these projects in lockstep with industry apologists benefiting from this scheme, we all know who we're talking about here, in lockstep with them, the cartel was able to forcibly impose expensive and completely unnecessary hedging mechanisms on producers while simultaneously gaming the synthetically diluted PM fixes. So acting as a cartel, this enabled the LBMA to gain full control of every single London fixing price. And it's precisely this ring-fenced activity that has enabled gold price discovery to be controlled by the 10 times larger, that was the not yet Basel NSFR compliant marketplace, the unallocated over-the-counter market, and it was, which were actually related, and because you're having unbacked over-the-counter market positions related to also unbacked, unallocated, and asymmetrically shorted gold futures contracts. In other words, the weighting was short in the futures markets. Now, it is this directly related price setting COMEX leg that has been setting the price of physically deliverable gold in the global markets, and that has since Basel III compliance in January 2023 has increasingly come under attack. So in retrospect, it would have been far better served for the CME to back off, not dig their heels in, as the UAE simply moved to cease seeking their pending LBMA accreditations, so as to focus on expanding their globally fungible Asian-facing UAE brands 49 bars, which were offered at a 1% discount to the refiners, and to the clients, basically undercutting LBMA branded bars. Now, all Indian supply actually flows through Dubai. So this was really a bonus for India, who was happy, who's accustomed to paying less than LBMA prices for their gold. So this battle between the UAE and the LBMA really marked a pivotal moment for the BRICs facing physical markets to increasingly set physical prices outside the cartel's reach. While it has taken 3 years, the blowback against the LBMA CME cartel is now really gaining traction. The LBMA is increasingly losing flow out of Africa into direct competition from the UAE, who has just formalized a direct conduit for African miners to sell their production in BRICs gold-backed currencies. It is no coincidence this UAE Africa conduit has been formalized ahead of the 40% gold-backed BRICs BIS Enbridge settlement stablecoin, which relies upon physical gold having been reclassified by the BIS as a global first-tier asset class. I think there's two things to note here. Now, the first thing to note is by cutting out the LBMA middlemen, African producers benefit from a frictionless, sanction-proofed, bail-in and confiscation-proofed instant settlement gold for gold payment process. Now, this direct settlement process removes the ability for LBMA CME cartel to silo and historically game this physical gold liquidity to their own advantage. Hence, we will see less volatility and better prices for a multitude of artisanal producers to receive for their hard-earned sweat and blood production. Essentially, African gold is entering a real-world, fairly priced, physical settled mechanism. This ends the high-friction process where local dealers have historically robbed these small miners of a fair price, settled them, taken 6 weeks or more to even pay them, and in many cases, netting them out really just half of the value of the end product. A very unsavory situation that really had to be resolved. And the UAE has moved to resolve it. This direct mine to refiner relationship will enable these small producers to improve their living standards, enable them to have fresh water, drugs, food, etc. Generally, a fair price for their bullion.
Wow, that's amazing, Andrew. Now, from the Vault community, we've got some questions here about the progress of the BRICS settlement currency and how this can ultimately affect the anticipated gold market reevaluation process.
Yeah, great timing for that, Shane. It's all coming to a head. Let's look at where we are in this process. And as we know, Basel III NSFR standards implemented on the 1st of January 2023 provided global central banks the mechanism to be able to revalue their physical gold reserves higher from a 50% haircut to a fully cash exchangeable first-year asset at a time of their choosing. Now, we are approaching the point where central banks will be able to pay off massive swathes of debt by investing excess FX reserves into physical gold ahead of a gold revaluation event. In fact, the global gold revaluation event is already underway by stealth. Look at the prices, driven by BRICs central banks openly racing to back their currencies by purchasing gold to better participate in the non-dollar denominated BRICs-controlled stablecoin settlement process. Now, the depreciating fiat currencies that the BRICS members have been and continue to swap for gold are immediately wealth protected. And as the process rolls forward, as they buy gold, obviously, and as the process rolls forward, the gold is locked out of the fiat gold system, tightening supply and forcing the gold price to naturally rise, as benchmarked against all fiat currencies, that is. Now, while not one-to-one correlated, purchasing gold into a rising gold price also serves to bolster the individual foreign exchange values of the participating 60% component of this unit stablecoin. This is the polar opposite of current dollar debasement. I mean, good God, in interest on naked short of gold debt, and we'll call it naked short of gold US debt, has now ballooned to $1 trillion and growing. It's staggering to even think about. But really, to answer the subscriber's question more fully, there's been a lot of natural skepticism about the decentralized BRICS Enbridge settlement currency being actually fit for purpose, or even that it'll be tabled at the Kazan meeting in October. However, our extremely well-connected contacts who have been accurate every single step of the way, from Sparebank digitizing physical gold on the first trading day of January 2023, followed by last year's beta testing of Glaziev's commodity currency, which later this year was affirmed after Glaziev's meeting with Russian Central Bank Governor Elvira Nabiullina, greenlighting the BRICS-backed stablecoin. And there's been other references to it by Putin and others. Now, while we have seen attempts by the US to divide the Sino-Russia alliance, the latest being that visit we outlined in our last episode, drawing attention to White House National Security Advisor Jake Sullivan. And he came in with this big carrot and stick visit to Beijing. However, we now weigh in some actually serious geopolitical sanction escalations, indicating this fungible, decentralized stablecoin settlement token, and I will reiterate, fungible, decentralized stablecoin settlement token will be formally launched in Kazan in preparation for the launch of the BIS-sanctioned Enbridge platform, the unit. This is a BIS-backed platform. Really, what's happened is every central bank, bar the Fed, has been loading up on as much physical gold as possible ahead of this. By stealth, the revaluation process is most definitely already underway with a minimum target of $3,000. Now, the misconception that the BRICS currency is not fit for purpose arises from a lack of understanding on how an asset-backed stablecoin token actually functions. The intrinsic value of each unit token always remains proportional to the total value of the unit reserve basket measured in gold, and as a result is expected to remain less volatile than the value of any of the components or other components of the basket. Now, each of the participating BRICS foreign exchange currencies will proportionately be weighted to the amount of the unit stablecoins allocated to that specific transaction. The more real assets a BRIC member has, gold, but also oil, commodities, etc., which value their FX country in the first place, the higher the weighting is. Obviously, gold actually exponentially raising that weighting. Now, obviously, the Sino-Russian alliance alone has accrued sufficient physical gold to physically flywheel the reserve basket measured in gold. How much is vended in will determine the weight of these offerings. And we see Russia as taking the baton for this next move higher.
Andrew, speaking about Russia, just before we started recording, you had mentioned that you had the rationale for the exact $3,500 Russian-driven gold price. Can you share that with us?
Yeah, absolutely, Shane. So really, following Russia international reserves rising to it was 609 billion in August. That was largely derived from excess oil revenues. A decision was made by the Russian central bank to increase gold purchases. And if you recall, around the 15th of August, we noted the unusually high gold demand and premiums coming out of Russia, with our well-connected Russian-facing liquidity providers remarking that this likely related to the plan to increase central bank reserves ahead of the BRICs Kazan summit next month. Now, these premiums have continued, and we have fresh evidence Russia is trading gold for goods. Now, all the pieces of the puzzle are assembling, some of them as yet unreported. Now, one of the clues as to where the Russian central bank expects gold prices to settle around or shortly after the BRICS currency launch came from our contact at Serdar, and I'll provide a link to this, who let out of the bag before anything was published that based upon the cross rates between central bank rate of 21% and the huge rise in leasing demand, which pays 5.5%, a 5% coupon on their gold bonds, the price should be 10,000 rubles per gram, which as of today equates to $3,516 per ounce. Now, the expected US dollar price for gold has since been made public, and it was published by TASS during the September 3rd holiday, and it's gone unreported, but here is the link. The next piece of the puzzle followed the next day on the 4th of September, with the official report that Russian gold output had increased by 5.9% in the first half of 2024, with almost all the production being absorbed by the domestic market. However, the Russian central bank is now allocating 1.9 billion for purchases of gold from September the 6th to October the 4th. So they announced that on the 4th of September. Now, domestic supply will tighten, prompting major producer Serdar to expect prices to rise over the next 6 months. Now we have the Sino-Russia price target, which is why we're evidencing such strong Asian-facing physical demand, with the AM fixes taking advantage of every Fed-driven official gold intervention. As was being relayed from our liquidity providers through its proxies, Russia was the reported large buyer. Notably, into the COMEX-driven sell-offs, ruble-denominated gold proportionately rose in price or has been rising in price into dips. Now, our liquidity providers also now tell us a large gold for oil deal has recommenced, enabling some of the massive 400-ounce monetary gold demand we've been tracking exiting the UK and Switzerland to be directly exchanged, through proxies of course, for Russian oil. In fact, at best estimate, real Russian gold reserves likely stand at around an unreported total of about 20,000 tons. This essentially puts the BRICS nations' combined gold reserves at around 80,000 tons. That we previously assessed that, and which is basically 40,000 PBOC, 25,000 available in times of citizens of crisis in citizens' gold that could be capitalized on, and 20,000 Russian and fellow countries, which is Saudi, etc., BRICS gold reserves. Now, Polyus also remarks on the unprecedented demand for gold driving ever higher prices. And according to their CEO, I can never pronounce it, Vostolikov, representative of the gold industry, sees gold interests not only to central banks, but also to Asian investors. I think I just printed out what he said here, which is, quote, there is a great demand from Chinese investors, retail investors who are starting to shift from real estate to the local stock market to gold. Experts also see demand from Western investors, including American ones, who have begun to actively buy gold. He said, noting that there is also demand from exchange-traded ETF tied to gold. Interesting.
Now, Andrew, can you tell us what you're seeing in gold right now? This is another question from the community.
Yeah, let's take a look at the degree of gold, the degree gold is devaluing the dollar.
Now, shorter term, in the meantime, into being forced to cover close to the top of the current range, the Fed has dug yet another deeper hole by borrowing 157 tons of physical gold from the BIS. Now, at best estimate, the last 9 tons, which were benchmarked at around about $2,460. So just to give you an idea of how wrong-footed they are now. And so in an attempt to cap, if you remember, in an attempt to cap gold at 2,000, we looked at this before, but I just want to reiterate that in their attempt to cap 2,000 spot gold in mid-February, an attempt to push back against China opening up the Shanghai Futures Exchange on the 1st of March. Liquidity providers estimate the Fed's likely aggregated stand-in cost for the whole 157 tons is around about $2,250, so around about this level here. That is over $337 per ounce under Monday's all-time record gold fix. In fact, it was the Asian-facing AM fix. I'll just open this up a little bit. And I've explained why we track the futures market, because this is where the COMEX footprints are really evident. The synthetic footprints are evident. But essentially, so the spot fix, the actual spot gold fix, was at 25.8745. Now, if you think about it, that's over $1.6 billion offside and rising. Now, while this borrowed gold liability can be keystroke squared by the Fed printing dollars, it will nevertheless require going to market with these freshly printed dollars to buy this physical at market to cover. And with supply already tight, agent banks exposed to physical delivery obligations they don't have, footprints evidence short covering close to the top of the range. Yeah, obviously we've got FOMC today, and I know you'll have this by the time it'll be in the rearview mirror when you get it, this episode. But all this is of course some gaming of the again, this is really the CTA gaming. Physical market is strong every single day. Every single day we see whether it's London, as soon as London cleared yesterday, for example, after trading inside a tight range all day, of course, they wait till the usual gaming goes on, where you wait for the London to clear, then you see Asia buying, then you see 2 a.m. selling, and then you just see short covering again. This is actually healthy consolidation. But what we're saying is the last 6 months of Fed capping efforts have backfired for all the reasons we've identified. But as we recently drew attention to at the opening of the Shanghai Futures Exchange to speculators, this was a strategic move by the PBOC to raise the price of their estimated 40,000 tons of gold salted amongst the state-held banks. This will act as a bargaining chip as they face down a very aggressive move by the US to ramp up geopolitical sanction threats against them. And we're looking at the quarterly chart here. And as we can see, these borrowed positions are deeply underwater and grossly mismatched to Russian BRICs gold price expectations of over $3,500 per ounce, a price that will force the Fed to revalue its rehypothecated gold reserves into a slew of repatriation requests from every other global central bank. So in summary, despite every effort to synthetically gap gold since the 16th of August, which was around here, what they've done is ended up digging themselves a deeper hole as they keep running into very, very strong AM fix Asian demand. So let me just go back and obviously see AM and PM fixes, but all the way along the way, it's been the AM fixes that face the Asian markets. And it's the AM fixes that really are causing the problems for the Fed, who obviously once the pit opens, they can actually add some synthetic supply. But the AM fixes is where the physical markets are getting settled. And it's been above spot 2,500. And while during the last 4 weeks, they've been able to chart paint 8 PM fixes just below the all-watched round numbers, and this is the equivalent spot 2,500 round number. So we'd seen 8 PM fixes below, but only 2 below, and each one of those spiked gold significantly higher because they'd run into massive T+1 delivery obligations, meaning that at a FX fix, because it's NSFR compliant, it has to be deliverable. And they were running into demand, give it to us. We've locked it in, and we're demanding T+1 delivery. And these obligations, they could not fulfill these obligations without borrowing gold from the BIS. And this has yet to be repaid. The sole reason the Fed-run cartel has not been able to ignite large synthetic sell-offs is because the NSFR-compliant physical markets are being settled outside the LBMA CME tentacles.
All right, Andrew, and what are you seeing in silver?
Well, I knew that was coming, Shane. Shane, let's take a look at the action and where we see the cartel folding their short hand.
Now, silver is in massive Indian and Chinese demand, and given the physical demand is centered outside of the LBMA ring fence, and that producers are increasingly circumventing the high-friction, unallocated so-called LBMA professional market, with the cartel, in other words, we've done a lot of work on them, silver looks ready to break out to the upside. Now, Goldman Sachs sees $37. However, a breakout above the COT stops above 32.75, which, if you remember, we talked about these stops here, are the trigger point that really will force the cartel to fold their hand. And these bets are linked to very large OCC bets, which is Office of the Comptroller bets, which are FX bets, are large enough, and this is where the stops are that we just looked at on the 4-hour charts. And then we would expect a move. Yes, there'll be the next technical resistance, but bearing in mind they'll be folding their hands at these levels. And bearing in mind, this is a gap close, which is going to really trigger another layer of shorts, until we really reach where there's no real technical resistance until 41.65. So we see silver being magnetized to that level simply on the basis of a scramble to short cover physical silver they do not have, and with supply not coming through the LBMA conduit, it is leaving them a much more illiquid, day by day, a more illiquid paper market to game. Now, obviously, we're recording this episode ahead of FOMC this afternoon. And as I say, it'll all be in the rearview mirror for you when this is published on Friday. But very short term, this is what we're seeing in both related metals. We talked about yesterday's gaming outside the range. Following a little short covering, COT short covering overnight. Again, the usual buyers come in, then we get to 2 a.m., we get another sell-off, etc., etc. But really what we're seeing here is very, very strong buying after this capping at the 2600 futures level at 2 a.m. Now, the anticipated consolidative CTA-driven behavior reflects commercials actually short covering into the top of the range. So in the bigger picture, covering into this bigger short-term range. Now, let's have a look at what we would expect. Now, obviously, you've got the advantage because you'll have seen what happened at FOMC. Because whether it's 25 or 50 basis points, it was going to influence Western actors. And if it stays at 25 basis points, we should expect some non-sticky CTAs to knee-jerk sell, and the dollar to probably spike higher temporarily. However, the current race into safe haven physical gold sub 3,000 will continue regardless. Currently, in anticipation of a dip, if it's just 25 basis points, which is probable, liquidity providers report very large central bank size bids related to the spot 2550 level, which is actually in futures terms is, let me just condense this up a bit so you can see. This is where, if you remember, we said buy stop sit above this level. What happened was they were hit and blown through. Now they're saying that there are bids below this level, at this level, central bank size bids again. So this is the rare first support it's going to be. And I think any dips sub spot 2550 equating to 25.75.90 futures will be jumped on. Hey, if it's 50 basis points, we will evidence large inflows into ETFs, gold inflows into ETFs, alongside a trigger for the avalanche of dollar selling as Chinese owners of dollar assets divest into Fed rate cuts. And either way, gold and silver are undervalued against the dollar. It's just a question of how fast the dollar devalues against gold. We're back inside. Remember, we were talking about sideways up, sideways up, sideways up. So this is another, but now we're coming to a point where we're actually seeing commercials short covering into the top of the range. I cannot reiterate that enough. And sure, while they take advantage of any short-term volatility, they are going to short cover into any sellers. So short-term volatility aside, liquidity providers report very strong T+1 overhang, which is still undelivered bullion that has been fixed at the fixes. So obviously we would expect this sideways to consolidative action to continue into FOMC. I mean, it's pretty much the same in silver, which is by no means overbought. And while clearly capped, and this represents the $31 spot level, because there's about a 33 to 34 cent contango in the futures market. So although it's clearly capped at this level, we're also evidencing commercials using dips to short cover their physical exposure. And obviously, we're going to track this closely. These are the levels we should be watching in gold and silver.
Well, guys, the only question that remains, yes, it's Robert Kiyosagi's question. How much physical gold and silver do you own right now?
All right. Thank you, Andrew Maguire, for talking gold. And remember, to our growing Live from the Vault community, buy physical and make sure it's backed 1-to-1 and understand the difference between what Andy calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same, and don't be fooled out there. So there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. Please help keep spreading the word about this channel by hitting that like button right now and sharing this information so more people can find out about this community. And if you haven't already subscribed, you can just hit the subscribe link right there. And if you click on the bell, you'll be notified in real time as each episode goes live. And with that, we'll see you next time right here on Live from the Vault. See you then.